Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone. Today we're doing a deep dive, looking at headlines from CNBC, Reuters, Yahoo Finance. And honestly, the story is kind of one of whiplash. Yesterday felt like a big deal, right? Historic close for the Dow. The government shutdown finally ended politically. But today, Thursday, November 13th, it feels like the financial world is really starting to grapple with the economic hangover. Our goal here is to unpack that hangover, especially this data vacuum facing the Federal Reserve and how all this uncertainty is, well, driving a pretty powerful split in the U.S. stock market.
That really is the core tension for investors right now, isn't it? You saw the Dow Jones Industrial Average close above 48,000 for the first time. I mean, a landmark number reported everywhere, up, 0.68%. But if you only saw that headline, you missed the other side completely. The tech-heavy NASDAQ composite, it actually fell. Dropped 0.26%. It signals a huge rotation happening under the surface. And that rotation, I think, is happening precisely because this political gridlock has now turned into a kind of economic information failure. Maybe we should start with the shutdown ending, because that really sets the scene for everything else.
Okay, yeah, let's unpack that. The longest U.S. federal government shutdown ever. President Trump signed the funding bill late Wednesday, formally ended the 43-day stoppage that was confirmed across Yahoo Finance, CNBC, and federal employees told to get back to work Thursday.
Right. But the initial market reaction, it was incredibly quiet, wasn't it? Treasury yields barely moved, which, as CNBC pointed out, kind of shows relief. We dodged a bullet, maybe, but zero real excitement about what's next. And U.S. equity futures, the S&P 500 and NASDAQ 100, they struggled a bit early Thursday, more like absorbing the hit than celebrating the reopening.
And that damage, that's what we really need to focus on. This wasn't just some temporary blip. There's an analysis from the Congressional Budget Office, Yahoo Finance flagged this, suggesting the U.S. economy is going to be permanently smaller by about $11 billion by the end of 2026, just because of this stoppage.
Permanently smaller. That's the key phrase. It's not temporary. It's a permanent drag from political inaction.
Why permanent, though? Is it just lost wages?
Well, it's partly lost productivity, sure.
Yeah.
But critically, it's also delayed investment decisions. Think about it. Businesses, consumers, they just paused for over a month. You can't just, magically get that time back. But the real structural headache, the thing that's dominating the conversation today, is this data vacuum.
This feels different from past shutdowns, doesn't it? This data issue.
Oh, absolutely. It's huge. The White House press secretary actually stated that key October economic reports, we're talking the Consumer Price Index, CPI for inflation, and the big monthly jobs report are likely never going to be released.
Never. Not just delayed, but never.
That's the official word. The data collection was apparently so disrupted for so long that the information is now considered permanently compromised, irrecoverable.
Wow. That's stunning.
It is. And it's a critical detail that came up in the reporting around Treasury yields.
Right.
Because it leaves the Federal Reserve, the people steering monetary policy, essentially flying blind at a critical period. They've permanently lost visibility on what was happening with inflation and jobs very recently.
And this isn't just about the Fed's big picture decisions either, right? There are immediate practical problems with restarting everything. Bloomberg warned about this, like the Transportation Secretary saying air travel chaos won't just vanish overnight. They're hoping to lift flight restrictions within a week, just in time for holiday travel stress, I guess.
Exactly. And think about the human side. Federal workers, yes, they'll get back pay, but actually processing all those payments. The target is November 19th. That's still a ways off. And maybe more critically, SNCP benefits. Food assistance for 42 million Americans. They're set to resume, but the states need up to a week just to update the files and get those debit cards loaded again. So immediate relief isn't quite immediate.
Okay, so the political storm has passed, maybe, but the economic fog is rolling in thick, which brings us straight to what the market's doing. Let's call this segment 2, the two-speed market. It really feels like the old economy is suddenly standing up to the AI giants.
That's a perfect way to put it. CNBC's Daily Open piece really nailed this split. You had the Dow hitting records pushed higher by those classic blue chips, Goldman Sachs, Eli Lilly, Caterpillar, companies that do well when the broader economy feels a bit more stable. But then the NASDAQ composites, stuffed with those mega cap tech momentum names, actually pulled back. Investors are clearly signaling, hey, maybe there's value outside that really crowded tech trade.
Yeah, Jim Cramer over at CNBC, he was pretty explicit about it. Said investors should look beyond tech now. He saw the non-tech rally as a really positive sign for the market's overall health after the shutdown ended. He specifically mentioned travel stocks, United, Delta, Expedia, and even restaurants like Chipotle and Brinker.
And it's probably a healthy rotation, right? Doesn't mean the whole AI story is over, not at all. But it suggests investors are maybe spreading their bets a bit, diversifying away from what became a very crowded trade. That said, even within AI, there's real strength if you look at the infrastructure side. Cisco Systems is a perfect example. Their shares jumped, nearly 7% in pre-market Thursday. That was after they boosted their revenue forecast for fiscal 2026, up to maybe $61 billion. That's a huge number.
A massive boost. What's driving that confidence at Cisco?
Well, according to Reuters and Bloomberg, it's pretty straightforward demand for secure networking, the stuff you absolutely need to, quote, unlock the potential of AI. Cisco reported landing $1.3 billion in AI infrastructure orders just last quarter, and specifically from the hyperscalers.
Ah, the big cloud guys. Microsoft Azure, AWS, Google Cloud.
Exactly. The AI boom needs tons of physical gear right now, and Cisco's providing a key part of that foundation.
Meanwhile, you see these huge money moves among the other big AI players. SoftBank, the big Japanese investor, their shares tumble again.
Yeah, second day running. They confirmed they sold their entire stake in NVIDIA at like $5.8 billion worth last month. And why? To pump funds into their pivot towards OpenAI tells you where they think the value is shifting.
And this whole infrastructure race, it's becoming intensely geopolitical, isn't it?
Absolutely. Reuters had a story on China's Baidu unveiling new AI chips, the P800 chips they call them, plus some supernode products. The clear goal there is low-cost, domestically controlled computing power, trying to find ways around the U.S. export restrictions. It just highlights this global scramble for AI self-sufficiency.
Which actually brings us to a really interesting point Yahoo Finance highlighted about the economics of AI itself, how it's fundamentally different from the old software model.
Yeah, the software as a service or SaaS model that dominated the last decade or so.
Right. How is AI different?
It boils down to resource cost, the old SaaS model. Once you built the software and got a customer, the cost of serving them more was tiny, almost pure profit, which is why you chased user growth like crazy. But AI startups, they face massive ongoing computing costs. Just the sheer electricity and processing power needed to train and then run these complex models is enormous.
So the profit margins aren't as easily scalable.
Exactly. Nicholas Colas, who Yahoo Finance quoted, argues this forces AI companies away from simple flat subscription fees. They have to use more proportional sales models. You're essentially paying for how much computing time you use, not just access. And this need to price high just to cover those huge resource costs. Colas says that's an underappreciated reason why AI valuations are so sky high right now. They have to charge a lot to make the math work.
Fascinating. Okay. So this market split, old economy, finding its feet, tech pausing, it seems directly linked to the Fed being kind of hamstrung right now. Which leads us perfectly into segment 3, monetary policy caution.
Yeah, this is where the reality of that permanently lost data really bites. You had Boston Fed President Susan Collins, she's a voting member on the FOMC this year, come out pretty strongly. She basically said there's a relatively high bar for additional easing, meaning she's really reluctant to support more interest rate cuts anytime soon.
And she directly linked that reluctance to the missing October data.
Explicitly. CNBC reported she emphasized being hesitant to ease policy further, especially given the limited information on inflation due to the government shutdown. Remember, the Fed relies heavily on seeing both the jobs report and the CPI inflation data together. It gives them a picture of the economy's momentum and price pressures. When you lose both permanently for a key month, it makes it incredibly hard to judge how much heat is really in the system or how much slack is in the labor market. So they're forced to rely on, older data, anecdotal stuff, which naturally makes them more cautious about cutting rates, especially heading into that important December meeting.
Makes sense.
Yeah.
And meanwhile, other central banks, the ones that do have data, are reacting to it, right?
We saw that clearly in Australia. Their S&P SX 200 index reacted to jobs data that came in stronger than expected. Unemployment ticked down to 4.3% when forecasts were for 4.4%, and immediately market expectations for an Australian rate cut dropped, and the Aussie dollar got a lift. It just shows how sensitive markets are to credible, timely data, the very thing the U.S. is now missing for October.
And how about Europe? Stocks there seem generally happier about the U.S. shutdown ending.
Yeah, mostly higher. Burberry was a standout, jumping about 7%. They reported decent comparable store sales growth, helped by the Americas and China.
But the underlying picture, say in the U.K., is still a bit shaky.
Yeah, the UK economy technically grew, but only by 0.1% in the third quarter. And there are still these background warnings about businesses delaying investment because of ongoing budget uncertainty there. So Europe gets some relief from the U.S. news, but local issues definitely remain.
Okay, let's pivot one last time to segment 4, the shifting sands in global trade, drawing mainly from Yahoo Finance here on the tariff front. Seems like there are hints of some very specific tariff relief coming from the U.S. administration.
Yeah, this is an interesting one. It feels like a politically savvy move to address cost of living pressures. President Trump and Treasury Secretary Scott Bessent hinted they might cut tariffs on certain foods the U.S. doesn't really grow domestically. They specifically mentioned coffee and bananas. Bessent actually said to expect substantial announcements over the next couple of days in terms of things we don't grow here.
That's a very targeted way to maybe ease some consumer pain without sparking big fights over domestic industries, right?
Mm-hmm.
But the really big picture, U.S.-China trade, that still sounds incredibly tense.
Oh, absolutely fragile. Morgan Stanley put out a pretty stark warning, also via Yahoo Finance, saying that the recent one-year trade truce between the U.S. and China is, quote, fragile. Their view is that because the underlying competition is still so intense, we should probably expect rolling negotiations, truces, and periodic flare-ups as the new normal. Constant instability, basically. And complicating even the truce is the fact that China apparently has a huge glut of soybeans right now, which could dampen hopes for big U.S. export sales, even though China did pledge to start buying again as part of the deal.
So, big picture uncertainty reigns, but smaller deals can still happen.
Seems so. There was news about Switzerland being close to finalizing a deal. It would lower U.S. tariffs on specific Swiss goods, think watches, machinery, down to a 15% ceiling. They hope to get that done maybe by the end of this week.
It really paints a picture of fragmented trade policy, doesn't it?
It does. You can get these targeted bilateral agreements done, even while the massive U.S.-China relationship remains fundamentally unstable.
Okay, so let's try and synthesize this for you, the listener, as we wrap up today's deep dive. The main takeaway seems to be this. The big political cloud, the shutdown, has lifted, at least for now. But that relief has almost immediately been overshadowed by a fundamental economic uncertainty, specifically this permanent gap in the Federal Reserve's data.
Exactly. And that data vacuum is forcing the Fed to be cautious on rate cuts. That caution supports the dollar, complicates things for borrowers, and generally adds a layer of complexity to the investment outlook. And this whole situation, the caution, combined with the end of the immediate political fear, seems to be fueling this complex rotation we're seeing, where the old economy blue chips are suddenly looking more attractive, challenging the dominance of the AI momentum stocks. The market's actively searching for diversification.
Before we go, let's leave you with a provocative thought, tying back to that AI race we discussed. We talked about Baidu and China pushing hard on its own advanced AI chips, trying to work around U.S. restrictions. Just consider the long-term implications if China or maybe other nations do successfully develop powerful domestic alternatives that compensate for U.S. export controls. How might that fundamentally reshape the global tech landscape, the supply chains, everything? That feels like a major structural shift to keep an eye on.
A really fascinating question. It could redefine tech leadership entirely over the next decade or so.
That brings us to the end of our deep dive into today's financial landscape. We'll see you all tomorrow morning with new headlines from major financial magazines.